This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Volatility and volume. Stocks tumble as bond yields rise, and a number of critical tech earnings are just around the corner. Put up or shut up. That's what a number of lawmakers are saying to President Trump when it comes to the high price of prescription drugs. Winning over millennials. Can the world's largest hotel chain compete with Airbnb? Those stories and more tonight on Nightly Business Report for Wednesday, October 25th. Good evening, everyone, and welcome. I'm Sue Herrera. Tyler Matheson is on assignment tonight. Big moves, big volume. The market hasn't seen that in a while. Today, the run-up we've seen recently cooled off a bit despite okay earnings and positive reports on the economy. The Dow Jones Industrial Average dropped 112 points to 23,329. The Nasdaq was off 34 and the S&P 500 fell 12. Bob Pisani has more on what drove today's declines.
A momentum sell-off on Wall Street today. U.S. stocks suffered their worst trading day in 2 months. The market's very concerned about a sudden spike in interest rates, and it got a couple reasons to be concerned. First, durable goods, products meant to last 3 years or more, rose much more than expected, a good sign for the economy, but raised questions about inflation. Second, reports that John Taylor may be the front runner for the Fed chair also spooked investors, since Taylor is known to want to raise rates faster than the Fed has been doing so far. That caused investors to take some money off the table, particularly with stocks that have had strong gains this year, like semiconductors. Even stocks with a decent earnings report, like Boeing, sold off because Boeing investors have had monster profits this year. It's been up more than 60%. Then there is uncertainty on what's happening on tax reform. The market's priced in a lot of good news here, but it's still not clear if it will get done. And today, some Republicans said that a plan to cut contributions to 401k plans was still on the table. That is deeply unpopular with the investing public. The bottom line, the market has told us it cares most about keeping interest rates low and tax reform. And anything upsetting those two pillars will cause stocks to move down. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And as Bob just mentioned, shares of Boeing fell today. The stock was down almost 3%, in part because of profit-taking after its big run-up. The drop came despite a strong quarter that saw plane deliveries hit a record and upbeat profit and cash flow outlooks as well. Phil LeBeau tells us why Boeing's business is expected to soar.
To understand why shares of Boeing have risen almost 100% in the last year, look at the company's commercial airplane business, starting with its signature wide-body, the Dreamliner. Not only is Boeing making more money on each 787 it sells, but it's also ramping up production. That's because demand for commercial airplanes is not slowing down. In short, more people around the world are getting on planes.
Airlines continue to report solid profits, and passenger traffic growth continues to outpace GDP, with traffic growth of 8% through August. Also, cargo traffic is experiencing a healthy recovery, with 10% freight traffic growth over the first 8 months of the year.
As airlines clamor for newer, more fuel-efficient planes, Boeing may raise production plans for its most popular model, the 737. In a couple of years, Boeing is scheduled to crank out almost 2 new 737s every single day. On the defense side of the business, Boeing is wrestling with higher costs for the new Air Force refueling tankers. But the first planes are still on schedule to be delivered next year. Overall, Boeing's defense business remains strong, giving the Dow component a solid balance sheet as it heads into the end of the year. Phil LeBeau, Nightly Business Report, Chicago.
Boeing is the best performing Dow stock this year, while tech is the best performing sector this year. Earnings for the group begins in earnest tomorrow with results from Microsoft, Alphabet, and Amazon. And as Josh Lipton reports, the biggest risk to this sector could come from regulators.
Tech has been on a tear so far this year. The sector is up 30%, about double the returns from the S&P 500. Tech portfolio managers expect the rally to continue, pointing to attractive valuation and strong growth prospects. But tech investors also point to one big caveat: the increasing drumbeat of political and regulatory threats targeting mega-cap tech companies, a clear shift in political sentiment.
Regulation is just bad, right? It's going to force innovation to happen where it's not. So if you regulate tech, you're just telling them to go do their innovation elsewhere.
President Trump targets Amazon, often incorrectly, suggesting that it doesn't pay its fair share of taxes. And Facebook's Mark Zuckerberg is in the crosshairs too, after acknowledging that Russian-linked actors bought ads on his platform to interfere with the U.S. presidential election. But tech companies are facing other potential challenges as well outside the U.S. European regulators now say that Google is breaching antitrust rules by requiring manufacturers to pre-install Google Search on their devices as a condition to license certain Google apps. That's important because it encourages people to see Google Search ads when they look for information on their phones. Google disputes the EU's claims, saying it's actually expanding competition, not hurting it. Some of the biggest tech companies in the world enter earnings season with a very different reality of increasing political pressure both here and abroad. For Nightly Business Report, I'm Josh Lipton, San Francisco.
So joining us now to talk more about the potential risks to the tech sector is Daniel Flax. He is the Senior Research Analyst at Neuberger Berman. Welcome, Daniel, and I understand it's your birthday, so happy birthday. Thanks for spending part of the day with us.
Great to see you, Sue. Thank you very much.
Let's pick up where Josh Lipton left off, and that is the specter of regulation. Specifically, perhaps not regulation here in the U.S., but maybe regulation on a more of an international basis. Does that concern you at all?
I think, Sue, it is a risk to these companies as we think about how they're going to evolve. So, for example, with Facebook and some of the scrutiny around the elections, I think it's a factor. However, the company, in the case of Facebook, is responding. They are putting more people in place to try and do a better job managing some of the ads. I think in many respects what's happening is that these giant technology companies are really maturing, if you like, relative to some other industries. Food, beverage, healthcare, all of these are regulated industries.
And so perhaps they're growing up a little bit and becoming more mainline companies versus not that they don't innovate, but they were always known as chiefly innovators, but the industry has matured.
I think that's right. I think whether one looks at how they're managing their businesses, obviously taxes is becoming a bigger focus area here in the U.S. as well as in some other countries. I think the key for these companies over the medium to long term is to continue to innovate and to continue to invest in their businesses so that they can deliver attractive products and services to their customers. And that is really the key to growth in our view.
Now, a number of these companies are coming out with their earnings beginning tomorrow. Your Neuberger Berman, I tried to say, owns Google, Apple, Amazon, Facebook, and Microsoft. But you're watching Microsoft most closely. Why?
Well, we think Microsoft is at a very interesting juncture. The company under the management team has really transformed the business mix and really embraced the cloud. So the move to the cloud is really capitalizing on some of Microsoft's core advantages in technology and importantly, their customer relationships. And so when we speak to their customers, they are telling us that they are investing more with Microsoft because Microsoft is bringing them along into the new cloud era.
Where do you think the market is in terms of its expectations for these earnings reports? I mean, the expectations have always been pretty high, but is the market anticipating something that perhaps some of these companies might not be able to deliver on?
I think in the short term, the market's obviously very focused on the results. In the case of Microsoft tomorrow night, we think that the company is likely to achieve or perhaps beat the consensus expectations. But what we're really trying to better understand from the results and certainly in the quarters ahead is how the company is continuing to transform its business. And that, in our view, is really going to be critical to Microsoft and these other giants to creating additional value for their customers and ultimately their shareholders as well.
All right, we'll leave it there. Daniel, thanks so much.
Thanks, Sue.
Daniel Flax with Neuberger Berman. Well, the cloud is fast becoming one of the most critical businesses for tech companies. That's the reason behind Google and Cisco's agreement to join forces to take on Amazon. That partnership combines Google's expertise in building massive data centers and open source software with Cisco's global sales force and customer support. Together, both companies believe that they can develop products to use in the cloud in a race to catch up with Amazon, which of course dominates the cloud infrastructure. Sales of Coke popped in the U.S. That company reported earnings and revenue that topped forecasts, helped by its new diet soda, Coca-Cola Zero Sugar. The new CEO says he's pleased with the results and backed Coke's full-year outlook. Fellow Dow component Visa reported a double-digit increase in profit, beating Wall Street expectations, driven by its purchase of Visa Europe as more people made payments using its network. Shares of both Visa and Coke moved in opposite directions today. A bit earlier in the program, Bob Pisani mentioned some of the positive economic news. Well, there was more. Sales of new homes rose to their highest level in a decade. Economists say that people unable to find existing homes due to a lack of supply are turning to new construction. Damage from last month's hurricanes may have also inflated that data. No position is more important to the economy than the chair of the Federal Reserve. Last night, we outlined the 5 people on the short list to become the next Fed chief. But today, there are reports that the White House's top economic advisor is out of the running. According to Bloomberg, the president does not intend to appoint Gary Cohn to the position. The president instead reportedly wants to keep him in his current role as his director of the National Economic Council. Some mixed messages for retirement savers. The top Republican tax writer says changes could be part of his party's tax reform overhaul. Today, when asked if the 401k tax break was on the table, the president backtracked a bit from his recent tweet where he promised no changes.
Well, maybe it is, and maybe we'll use it as negotiating. I think Kevin Brady is fantastic, but he knows how important 401ks are.
There are reports that Republican lawmakers are considering capping the amount Americans can contribute to these plans at $2,400 a year. Meantime, over at the FCC, that agency plans to vote on rolling back landmark media ownership regulations. Those rules limit the ability of companies to own multiple TV stations and newspapers in the same market. Such a move would be a win for newspaper companies and broadcasters. Others say it could usher in a new era of media consolidation. Still ahead, the big push by lawmakers to lower the price of prescription drugs. Dow component Nike setting aggressive new growth goals today. The sporting goods company sees earnings per share growing in the mid-teens over the next 5 years, driven by online sales and new products. Nike also sees revenue up in the high single digits over the same time frame. CEO Mark Parker says naturally the U.S. is critical, but overseas markets will also play a big role in that growth.
We also see that in Asia Pacific, Latin America, and then, of course, Europe. So all parts of international business are going to be growing. China is the biggest. If you look at the population, the target population in China for Nike, it's really moving toward 10 times that of what it is in the United States. And the appetite for Nike in China as the #1 brand is incredibly strong.
Wall Street liked what it heard, sending shares up nearly 3%, making Nike the best performer in the Dow today. Shares of the health insurer Anthem touched their highest level in a year after higher premiums and stronger Medicaid and Medicare enrollment helped that company easily beat quarterly earnings expectations. The insurer also raised the lower end of its full earnings estimates. Anthem also says it sees its participation in the Affordable Care Act plans to drop sharply next year amid what it says is too much uncertainty around the future of those marketplaces. Shares jumped 5% to break through the $200 per share mark. The bipartisan Senate proposal currently on the table to help support those ACA insurance marketplaces would cut the deficit by nearly $4 billion over the next decade. The nonpartisan Congressional Budget Office says the plan wouldn't substantially change the number of Americans with health insurance. It is unclear if that legislation introduced last week by Republican Senator Lamar Alexander and Democratic Senator Patty Murray will ever be voted on by Congress. This month, California passed a law hoping to rein in drug prices, and today, 4 Democratic congressmen made their push. Meg Terrell explains.
It was one of the few, maybe only things both Donald Trump and Hillary Clinton agreed upon on the campaign trail.
Drug companies have prevented us from enabling Medicare to negotiate for lower prices.
Drugs with Medicare, they don't bid them out. They don't bid them. They pay like this wholesale incredible number. They say like 300 billion could be saved if we bid them out. We don't do it. Why? Because of the drug companies, folks.
And when Trump was elected, he continued to insist that drug prices should come down. But so far, there's been no major action from the government.
But we have not heard a peep. Radio silence.
4 congressmen today introduced a bill that would give Medicare the power to negotiate the price of drugs.
It's so simple because it exists in every other major country on earth. It is time for Medicare to be able to sit down with the drug companies and negotiate prices.
Senator Bernie Sanders, along with Representatives Elijah Cummings, Lloyd Doggett, and Peter Welch, cited Kaiser Family Foundation data showing more than 90% of Americans favor giving Medicare the power to negotiate. Those congressmen are all Democrats. Republicans in Congress have typically blocked any attempts to give Medicare that power, attempted time and again by Sanders, Cummings, and others. The drug industry opposes the bill. Lobbying group Pharma said it would bring about, quote, government-imposed price controls and jeopardize access to critical medicines for seniors and people living with disabilities, allowing the government to decide which medicines patients can and cannot get. And the Republicans have typically sided with the drug industry on the issue. The party's major exception has been Donald Trump. But with no major action since he took office, drug stocks have rallied. Drug price increases don't appear to be slowing either. This week, analysts reported that drug maker Celgene raised the price on 2 medicines, each by 9%. For the $7 billion blood cancer drug Revlimid, it was the 3rd price increase this year, bringing the list price of 28 pills to more than $18,000. Celgene said in a statement that its, quote, pricing decisions reflect the benefits that our innovative therapies provide to patients, the healthcare system, and society, and said it continues to invest in more than 43 potential treatments currently in clinical trials. For Netley Business Report, I'm Meg Terrell.
Glaxo sinks on concerns about its dividend, and that's where we begin tonight's market focus. Glaxo posted higher quarterly results helped by stronger sales of prescription drugs and consumer healthcare products. The company also said it would consider a bid for Pfizer's over-the-counter business should Pfizer put it up for sale. But the prospect of that kind of deal could top $10 billion, and that stoked fears of a dividend cut. That sent Glaxo shares down about 6% to $38.19. Profit at the world's largest biotech company, Amgen, beat Wall Street expectations, helped by lower costs and higher operating margins. That helped offset a drop in sales of the company's more established products. Amgen also raised its full-year adjusted profit forecast, despite taking a hit to its Puerto Rico operations from Hurricane Maria. Shares initially fell following the after-the-bell earnings and also ended the regular session down about 1.5% to $177.50. Shares of Advanced Micro Devices continued to get hammered today following the company's earnings, which came out late yesterday. The chipmaker's profit and revenue beat expectations, but the company says it sees revenue falling 15% quarter over quarter, and that sent shares down more than 13% to $12.33. International Paper beat earnings expectations thanks to price hikes in some key businesses and lower outage costs, despite being hit by 2 hurricanes. The company says it is confident it will hit its full-year earnings target. IP shares slipped 1% to $57.99. Late last night, the Senate, by the narrowest of margins, took a final step to keep new rules from going into effect that would make it easier for consumers to sue banks. Kayla Tausche explains.
A late-night vote in the Senate rolled back a rule that would let consumers band together in suing banks and credit card companies, rather than fighting issues alone through a process called arbitration. Vice President Pence cast the deciding vote.
And the joint resolution is passed.
The Consumer Financial Protection Bureau introduced the rule this summer to give consumers the chance to hold banks accountable over small sums of money. It would have taken effect next year. Congress moved almost immediately to toss it out, using power to overturn regulations drafted only recently. The House voted to do so in July, as industry groups argued that scrapping it will mean banks won't be weighed down by lawsuits.
Had they gotten rid of this rule and accepted the CFPB rule, I think it would have been much more costly for the consumer to do business at a bank.
Treasury says the move will spare banks from 3,000 lawsuits and nearly $2.5 billion in legal and settlement fees. Democrats point out the move protects companies recently embroiled in consumer scandals like Wells Fargo and Equifax. CFPB found 75% of consumers don't know whether their financial accounts carry this fine print, barring lawsuits.
This bill is a giant wet kiss to Wall Street. Bank lobbyists are crawling all over this place, begging Congress to vote and make it easier for them to cheat their customers.
President Trump is expected to sign the bill, which the White House in a statement called a win for everyday consumers and community banks and credit unions.
Republicans continue to take aim at what they call an overreach of power at the CFPB. A senior White House official says overturning these new agency rules is one way to keep pressure on Richard Cordray, the sole figurehead running the CFPB tapped by President Obama. For Nightly Business Report, I'm Kayla Tausche, Washington.
Coming up, Marriott gets hip.
One legacy hotel operator is flipping the script in their strategy to appeal to millennials. This includes an urban amusement park on the roof and this rotating carousel. The full story coming up on the Nightly Business Report.
President Trump is launching a program to expand the testing of drones in order to speed up the integration of those unmanned vehicles into the national aerospace system. A White House advisor said the expanded testing will open up the skies for delivery of medicine, packages, inspection of critical infrastructure, and support for emergency management operations. But the White House stopped short of proposing new regulations allowing broader use of drones. Starting tomorrow, new security measures will take effect on all U.S.-bound flights, including stricter passenger screening. The measures are in order to comply with U.S. requirements put in place to avoid an in-cabin ban on laptops. Some of the new steps could include short security interviews with passengers. More than 300,000 passengers arrive daily on about 2,000 commercial flights to the U.S. And the NAACP has issued a travel warning for American Airlines. The group is cautioning African Americans that if they travel on American, they could be subject to discrimination or possibly unsafe conditions. The group says it has seen a pattern of, quote, disturbing incidents over the past several months reported by passengers, including some being removed from planes and others required to give up their seats. The NAACP says the incidents point to a corporate culture of racial insensitivity and possibly racial bias at the airline. American says it is disappointed by the announcement and it will invite the civil rights group to meet. And finally, tonight, millennials make up the largest part of the workforce, and Marriott is looking to attract the growing number of young professionals traveling for leisure and also for work, particularly since corporate travel makes up half of Marriott's total revenue. But will the strategy work? Seema Modi has more.
Marriott is opening its newest Moxie Times Square, but it's definitely not your father's Marriott. From rooms that have wall pegs to hang clothing to the largest indoor-outdoor rooftop bar in New York City, Marriott is going after the millennials who would rather stay at an Airbnb than a hotel. The hotel is catering to the mindset of those 24 to 34-year-olds. Starting with the layout of the room, many of which are geared towards the modern traveler, like this 220 square foot quad bunk room, outfitted with 4 twin-size beds, a foldable table and chair, all starting at the price of $139. Marriott Chief Global Development Officer says the room is intentionally small, since young travelers spend most of their time outside of the room.
You've seen the guest rooms, while very well appointed, are quite small, but a big focus on the public spaces in this hotel. And when you look at economic and demographic trends for the next generation of traveler, they want to be out in public.
But there are still some places inside Moxy to socialize, like that rooftop bar that has mini golf and a rotating carousel. And for those who come here purely to grab a drink but decide last minute they want to spend the night, Moxy has a room called the Crash Pad, which guests can book only from the rooftop cocktail menu for $99.
But the competition is fierce. Marriott's main rival, Hilton, has launched 2 brands aimed at the millennial-minded, True and Canopy. Radisson's Red and Starwood's Aloft, which is now owned by Marriott, plus the Hotel, an independent brand all geared towards the young.
Travel experts say in order to stand out, Marriott will have to be strategic in its marketing approach, relying heavily on social media to target millennials, especially as more enter the workforce and spend a larger percentage of their discretionary income on travel. For Nightly Business Report, Seema Modi, New York.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening, and we will see you right back here tomorrow.